All right, we're back with the Veterinary Ledger Podcast. Here we explore the business of veterinary medicine from ownership and operations, finance, leadership, and practice growth. Each episode, we talk about practice owners, industry experts, and veterinary professionals. Today, I'm excited. We're going to take a little bit of a pivot. We're going to go into lodging and ledgers. We're going to be talking about pet resorts. No better than these two people to talk about them, Jacqueline and Claire over at Live Oak Bank. Thank you both for joining the podcast.
Thanks, Jay. We appreciate you having us.
Absolutely. So we'll get right into it. I think maybe hearing a little bit about you both, your backgrounds, and in how Live Oak kind of helps lend to the pet resort industry.
Awesome. My name is Jacqueline Pait, loan officer here at Live Oak Bank, and we focus solely on lending money to the pet care facility industry day in and day out.
Hi, my name is Claire Cronin, and I too lend in the pet care facility lending here at Live Oak, and we're excited about this opportunity. Thank you, Jharid.
Absolutely.
Yep.
So when we think of the pet resort industry, clearly it feels like it's rapidly growing, right? So what are the conversations? What are some of the conversations that you're having and seeing, whether it's on the acquisition side, the startup side? I guess I just want to listen to kind of, what some of those are.
Yeah, absolutely. So kind of give a little bit of background about the bank. So we historically, our bank, actually we started lending money to veterinarians, but that's kind of how our sole focus is specific industries. So our veterinary team in about 2017 saw an opportunity to kind of expand into what we call pet care facilities. So non-DVM owned boarding, daycare, grooming, training, really anything pet care facility side. But yeah, no, when we first started lending in that space, we saw a lot of acquisition opportunity, expansion opportunity. Throughout the past couple of years, we're really seeing all of the things: acquisitions, expansions, startups. Really, years past, it's kind of been segmented where, a couple of years ago, we were really heavy on the startup space. We're seeing a ton of interest come into this space. So really, it's kind of been a great mixture of all product types.
And when you think of that, like expansion and or, growth within the pet care facilities, we have a handful that operate their facilities right on side of their property, right? So you have the home, and then whether either connected or a little bit detached is the facility. How do you go about, breaking that up from a lending perspective? If, I want to build the facility on my residential property, is that an issue for you from like a deeding lending purpose, or that's kind of normal for industry?
So that's a great question, Jharid. And again, this is about the only industry that you can actually have a home on the property, and it's part of the business per se. Typically, we will look at the pet care facility and what we're going to be building for that. We do not use any funds associated with, making your house nice or anything else like that, but it all is on the property of the pet care facility. So from what it is, appraisal day one, all the way to so as is once we get those budgets from the contractors and everybody else.
And does it matter if you have a traditional residential mortgage on the property, or how does that work if the underlying property is already kind of mortgaged up?
That's totally fine. As long as zoning's okay, we can either build the second facility or the facility on your existing property, or we can do both. The zoning is really what matters from a lending perspective. So if you have an existing home and you have property available and you're looking to build a facility on your property, we can certainly do that as long as zoning's okay. And we would just take a junior lien of your property.
Gotcha.
And Jharid, we're more niched here as well. We do have a construction component with Live Oak. So once you get through the process of getting a proposal into underwriting, getting that commitment to land, we start the closing process, and we also have a construction component to that as well. So you have a construction specialist who is able to walk you through that process. They will work with your contractor. We will pre-qualify your contractor on the front end. That doesn't mean to say that you have to use who we want. We just want to make sure that it's a contractor who knows what they're doing, is going to finish the project, because we're known for starting a project and continuing it out. So we don't have to do something, is what I'm trying to say there. But I think it's very important to know that you also have that person in your pockets, that their invoices will come through you. And then once you approve those, and the amount gets dispersed then. So I think that's a little bit of a different angle from somebody else in the industry.
How does that construction process work? Because I'm assuming it's not overnight, right? It takes 6-9 months for the entire process. You're loaning money, you're paying probably the contractors, vendors directly. As me as the business owner, am I on the hook for principal and interest payments immediately? Is there like an interest only period? What's like the traditional format for that piece of it?
Yeah, so we really look on project specific, which is nice. We'll work with the owner as well as the contractor to see kind of what the project is going to take from a timeline perspective, and then we'll structure the loan accordingly. So we can build an interest only period to kind of cover those construction and, potentially some ramp up so that the customer is not on the hook to pay principal and interest. The last thing we want to do for the customer is to make them liable for principal and interest payments before they're even potentially generating the revenue from that startup or expansion. And to kind of go a little bit further into that, the SBA loan also allows you to build in an interest reserve. So you can potentially have funds in an interest reserve that are part of your loan that can make those interest only payments for you. So instead of only being on the hook for interest only payment, if you choose to have the interest reserve, you're really not coming out of pocket with anything until it converts over into your principal and interest.
And when
And
it can,
important to note there as well, if it's real estate, if you're purchasing the real estate, it's over a 25-year term. And if it's a leasehold, it is over that 10 years. So what that means is the leasehold had 6 months of interest reserve, and the real estate has up to 12 months, if not about that as well, depending on project status.
I mean, I would see that's be like a no-brainer, right, for the business owner of making sure they're staying as liquid as possible. What does that look like though after, doors do get open? Are you also able to provide any, working capital funds available immediately for people cost growing the business?
Absolutely. So the SBA loan, so we're an SBA lender. Primarily everything we do in this space is going to be an SBA loan. There's a couple different product types for the SBA, which we can dig into all of them depending on, what is best fit for the customer. The 7A product with the SBA does allow for a lot of flexibility with your use of proceeds. So it does allow us to build in working capital, which is really nice. There is another loan product, the 504, which is more real estate heavy, and it doesn't really allow a whole lot of working capital. So sometimes we will go, especially for like a startup or an expansion of a second location, the 7A route so that we're able to build in that working capital. Because to your point, Jared, there's a lot of costs that are associated with that ramp up. And last thing we want to do is make sure that you're fully capitalized in order to succeed with that new location.
Talk to me about the lending decision, right? Because we always have, whether it be on the acquisition side or the sell side, the conversation where maybe, tax returns don't mirror true operating results. Hey, there's some cash that didn't make its way into the bank account, or our people costs were a little bit lower than they should because of those, cash payments to employees. Obviously, this, tax code is black and white, but, too often, in my opinion, I find that the seller feels like, nope, it's still good, right? That's, it's still monies I've received. But to me, it didn't make its way in the tax return, so I can't count it as profitability or EBITDA. What is your take on that?
And we have exactly the same take on that as well, Jared. It comes down to whatever you put in your business tax return. That's the number that we're going to work off of. We're not able to, lean in and, listen to what you have, whether it's under your bed or wherever it is. It's money that we just can't see and we can't take into account at all. We will sometimes take into account, obviously, if someone is selling their business and the owner is truly not part of the business, and we're able to know that the person stepping into that is taking on the same role. So we're able to kind of maybe do that little bit of it back as well.
And how many years are you analyzing there? So like, say that did happen. Hey, 2024, I got improper advice and maybe I didn't report everything. Can I cure that by just my upcoming 2025 return? Or do you need to see multiple years of kind of cash flow and history?
We are required to see 3 years. So we collect 3 years of business tax returns. This industry is very historically notorious for running a lot of personal funds through their business. We know the reason why, but when it comes to lending rate, we have to go off those tax returns. So that's why we are actually, Jared, honestly, we're so excited that you guys at Granite Peak have been expanding into this sector of the vet world too, because it is so important for these clients to have a CPA, at least a bookkeeper that can help with their finances and their books. because we do, when it comes to lending, whether that's you're looking to acquire a business, whether you're looking to expand, or whether you're looking to sell eventually, your books have to be in order for a lender that's going to require typically the 3 years of the tax returns.
I mean, this turned into not just informational, but a plug. This is outstanding.
Yeah.
It's great. That's great. Does your mindset change where, hey, I already have an existing facility, I want to go on to number 2 or number 3? Do you analyze each independently? Do you take some of the cash flow that opportunity number 1 is generating to help support the additional growth? Because again, we have a bunch of these business owners looking to jump into, a more scalable model. How do they get the lending for it all?
Absolutely. And that's something that we take, we will look at the 3 years of business tax returns on their first facility. And we know that this will not, come to a cash flow. So we then get into projections. So what that means is we're going to look for 3 years of projections for the new opportunity that you're looking into to kind of see the scalability and how that looks. And does that make sense to move forward with the second opportunity? Again, we're looking for cash flow, being that cash flow lender, making sure that we're able to expenses and self of money left over. So I think it's very important to look to see how that's going to do as well.
And one thing I want to add to that too, Jharid, is when you have been in business for at least 1 year, after the year mark, you're considered an established business. So whether you are looking to expand your existing operations or expand by an acquisition, by purchasing a new location, under the SBA's eyes, that's considered an acquisition as long as your ownership structure is the same. So you can potentially qualify for up to 100% financing, not only to expand your existing operation, but if you do want to expand by acquisition as well. So to Claire's point, we look at historical financials to make sure the growth makes sense from a cash flow standpoint, but we also take into account the projections because obviously it's going to be generating new revenues as well.
How much weight though do you put on the projections? Because I've seen some advisors put these really aggressive growth trends in a spreadsheet that made the numbers look really attractive from a profitability and cash flow standpoint. Do you look for reasonableness and spot check it with like industry benchmark it against the industry standards and KPIs as well, and then go back to the business owner and say, hey, $2 million of revenue over the first 12 months is probably unrealistic. Let's go sharpen the pencils and try this one again.
And looking at that as well, Jharid, whenever we're underwriting the opportunity, our underwriter is taking a deep dive into that to look to see what the owners have put in for their projections. And they're always going to kind of take those down because, again, we'd rather see, more profitability. But at the same time, we want them to be able to get to this number that, they say they are rather than, giving them a number that's not attainable at all. And again, with having our portfolio, I think that also helps us to be able to look and gauge that as well. But to your point, we do have that background and feasibilities and everything as well.
Yeah. So the good thing about us having a portfolio where this is what our team does day in and day out is we really know what the margins kind of should be. And so if they are out of whack, we can identify that immediately. And to Claire's point, if we need to scale that back conservatively to make sure that it makes sense from an average of, industry average that we typically see, we can do that. And we know what's potentially unattainable or if it makes sense.
Stay on that point. Everyone wants the magic numbers. All right. What is the ideal profitability? Where's these, 3 to 5 KPIs that I need to benchmark my business against? Vet med, we talk about EBITDA profitability being, ideally 14 to 18%, somewhere in there to show that you're a healthy, viable practice. In the pet care facility world, is there that, net normalized earnings profitability target that you just spot check it and say, yep, we're trending the right way with this opportunity?
To me, it kind of depends on what the services are. So again, kind of regrouping back, the reason we expanded and kind of are looking in this space is because the margins are very similar to a vet practice. So, we usually see low 20s. We have actually recently, though, seen when services are focused on certain things other than others. Obviously, boarding is going to be your moneymaker. If it's more daycare heavy, the margins might be a little bit smaller. We're seeing larger margins right now in like board and train and training specific facilities. So we definitely have kind of an average that we typically see, I would say around the low to mid 20s from a margin standpoint, but we have seen some outliers of where it makes sense and they've continue to perform that historically.
Makes sense. We get someone listening and they say, hey, I want to avoid this problem. What's something that, you've seen that you said, hey, I wish, had we had a conversation earlier or sooner, or you brought us in, we could avoid this. Is there any, major pain points that you've had to walk a pet care facility owner through?
I think the biggest one for us is someone will buy the property prior to talking to a bank because it's such a great piece of real estate, and they forget that they need that special use permit. And that's something that we can't close on without that, regardless of whether you own the property outright or not. It's something that we need to move it forward. So I think that's normally the biggest problem that we see. And again, with municipalities and counties, it can take anywhere from 3 months to 6 months to 9 months. So there's no time frame, and yes, purchase the land, but you can't move forward and close a loan until you get to that portion as well.
That's a bad one. That's a bad one.
Yes.
Staffing I would say staffing too is a tricky one that we get a lot of feedback. It's hard to keep staff. It's hard to keep staff for certain rates. So that I will say, even in the past 8 years that we've been lending in this subsector, that has changed a little bit to where staffing margins have increased from when we were started in lending in this industry. So that's kind of a pain point that we hear from like a customer's perspective.
Understood. Well, I want to be mindful of both, Jacqueline, and clear your time. But before we jump off here, when's too soon? Like, I have an idea. I want to get into the pet care facility, but I haven't identified a property. I don't know if I'm going to buy or lease. But again, I like the idea of it. Is that too soon to reach out to you? Should I already have identified a property? Walk us through like the timeline of when we connect and what's next.
Yeah, it's never too soon. So we always say, get us involved as soon as possible. We will be a great resource to tell you like, hey, we need to start application today. Or if it is very front end, we love to help build teams. If you need to get in touch with a consultant, a commercial realtor that can help you identify a property that knows the space, we can help you connect that. So, we really like to guide our customers, whether they're ready day one again to move forward, or if it takes a while to kind of get their ducks in a row. Get us involved as soon as possible. We love to help with that process.
Makes a ton of sense. I got to say though, and you mentioned it just then, I think the best thing, and not just about you both, but your bank in general, is you're outstanding lenders, but you're also connectors. Like you fill an advisory seat. It's not just, hey, here's a loan, start paying me monthly. It's, hey, we can finance you, and I'm going to put you in front of, like you just said, the attorney, the contractor, all the other pieces. It's such a comprehensive service that often gets overmissed, where people just say, hey, I just need a loan and a decent interest rate and tell me what I owe the bank. Well, that's great. A lot of banks can do that. But I think just your niche and knowing who you are, again, being that connector, has been invaluable to all of our clients that work directly with you.
And I think that's a great point as well, Jharid, is that we are going to say no. We may not always say yes. We may not be the bank for you. If you're looking for that rate and it needs to be, and we're at a different, like, we just know that we can't match what you're looking for, and we just have to unfortunately part ways. But again, we do know the contractors, we do know the CPAs like yourself who has now entered the industry. But again,
well, you just said CPAs. I thought that sounded plural. I mean, I thought it was that's a little better.
CPA. But again, it's just getting people into those relationships and making sure they have that team. I think we worked in a couple of opportunities together, Jharid, and it wasn't the right opportunity for our borrower. And again, that was a conversation to have. But at the end of the day, we made the right decision for those people.
Yeah.
100%.
And ultimately, it helps everyone, right? It helps the customer be able to find a team that is knowledgeable, experts in the industry, going to lead them down the right path. But then it also helps everyone involved. The last thing we want to do is a loan for someone that ends up not having a successful business. So we want to help guide and create that success and connect them to the right people that know what they're doing and know the industry. And, contractors that might not be the cheapest, but we know that you're not going to have to go 2 years down the road and upgrade your HVAC or whatever it might be. So yeah, we do spend a lot of time really learning the industry, but then also getting connected with other experts in the industry as well.
I know I said we're going to wrap up, but you made a great point. So last thought, what is that success rate? Because I feel like with you all in Live Oak, it is tremendously high of like loans that get funded to loans that get fully paid off. It doesn't feel like you have many, bad debts.
Yeah, knock on wood. We do a lot of due diligence. I mean, our default rate is very low, but that's kind of because of all the due diligence we do. And to Claire's point, a customer, if they're not ready, we're not going to push them until they're ready, but we're going to guide them to let them know what they can do, what they need to do with their finances, who they need to get connected with, how much they need to grow to where a new facility can support extra debt. So we really are not going to ever push to just get a loan closed. That's not how our bank works. We're not commission-based lenders. And so really the customers that we know are ready and believe in are really who we're going to pursue. And if they're not ready right then, we're going to try to help guide them, know the step they have to take in order to get there.
Makes a lot of sense. Makes a lot of sense. Jacqueline, Claire, thank you both very much for joining the podcast. Look forward to, chatting with you both soon.
Awesome.
Thank you
Thanks,
so much,
Jared, for
guys.
having
Alrighty.
us. We appreciate it.
Bye.
Bye.